When it comes to dividend aristocrats, many of them have not performed all that well in 2023. One of the reasons is due to the high rate environment we've been going through, and many investors are seeing high yield savings accounts that offer high yields and very little risk. Looking here, you could see year to date, the ProShares S&P 500 Dividend Aristocrats ETF, stock ticker NOBL, is up only 5% on the year, badly underperforming the S&P 500, which is up nearly 25% here in 2023. In addition, many of the gains that we've seen in the S&P 500 over the past year have come from the technology sector as well as communication services. And really, you're not going to find many dividend aristocrats in either of those two sectors. As such, with rates expected to come down in 2024, it could be a tailwind for many dividend stocks that are out there. So now is the time to start looking at those beaten down, high quality dividend aristocrats. And in today's video, we're going to take a look at 3 high quality dividend aristocrats that appear to be trading at intriguing valuations. But before we begin, do me a huge favor, smash that like button down below, subscribe to the channel so you're notified anytime we drop new content, and let's jump into it. Hey everyone, if this is your first time joining the channel, my name is Mark Rusin. I'm a CPA and not a financial advisor, so please perform your own due diligence. And before we begin, let me thank today's video sponsor, which is The Motley Fool. The Motley Fool has a ton of great resources and products available for investors of all different levels. And right now, if you go to fool.com/Mark, you could sign up to receive their 10 best stocks to buy right now. All right, let's jump back into our video, taking a look at 3 cheap dividend aristocrats. Remember, to be a dividend aristocrat, you need at least 25 consecutive years of dividend growth. Beginning with dividend aristocrat number 1, the Coca-Cola Company, stock ticker KO. The Coca-Cola Company is the largest beverage company in the world. They are a global brand. The company currently has a market cap of $259 billion, but on the year, shares are down 6%. The company has been going through a bit of a transition over the past handful of years under the leadership of CEO James Quincey, as he has actually reduced the number of SKUs, the number of products that the company has, choosing to focus primarily on the most profitable products that are out there. In addition, the company has been negatively impacted by a lot of the attention that these weight loss drugs have been getting, these magic weight loss drugs. However, Mr. Quincey has alluded to these drugs, stating that the company has been preparing for a low-calorie future for years. In the company's latest earnings report, Coca-Cola reported revenues of $12 billion, which was an 8% increase year over year. EPS on the quarter came in at 74 cents per share, a 7% increase from the same period in 2022. Looking at operating income, that grew 6% to $3.3 billion, but the company did see operating margin tick lower by about 50 basis points compared to last year. In terms of free cash flow, the company generated nearly $8 billion through the first 3 quarters of the year, which was 8% higher than the prior year. The Coca-Cola Company did see free cash flow margins actually increase by 50 basis points. So there we saw through the first 3 quarters, free cash flow margins are up 50%. However, in the latest quarter, operating margins actually fell by that same 50 basis point threshold. When it comes to assessing the safety of a dividend, one of the first things I always do is look at the free cash flow payout ratio. After all, free cash flow is where the dividend is paid out of. And when we're looking at Coca-Cola, Coca-Cola has a free cash flow payout ratio of 51%, suggesting the dividend is plenty safe. Right now, shares of Coca-Cola yield a dividend of 3.4%, and the company has increased their dividend for 61 consecutive years, making them not only a dividend aristocrat, but also a dividend king. Now let's turn our attention to guidance, where analysts are looking for the company to grow EPS by 4.5% next year to $2.80 per share. In addition, analysts are calling for revenues to come in at $46.88 billion, which would be a 3.2% increase from this year's estimates. Using those figures, let's now take a look at valuation. On a current basis, shares of KO currently trade at 22 times. And utilizing the 2024 estimates, shares of KO trade at a forward earnings multiple of 21.1 times, which are both well below the company's 5-year historical average of 25.8 times. In terms of price targets, analysts have an average 12-month price target of roughly $64 per share for Coca-Cola, implying roughly 9% upside from current levels. Moving on to Dividend Aristocrat number 2, which is PepsiCo, stock ticker PEP. We went from the largest beverage company in the world to now the second largest beverage company in the world with Pepsi. However, they're not just a beverage company, they also have an entire snack portfolio as well. The company currently has a market cap of $239 billion, and on the year, similar to the Coca-Cola company, shares of PepsiCo are down 6%. As I alluded to when talking about Coca-Cola, PepsiCo is in the same boat when it comes to the negativity around the weight loss drugs that have been coming out and the declining volumes that many expect to happen when it comes to PepsiCo, probably even at a bigger degree given their snack portfolio. However, I really believe a lot of this to be overdone for both Coca-Cola as well as PepsiCo. Let's take a look at their latest results. During the company's third quarter, PepsiCo reported revenues of $23.5 billion, which was a 7% increase year over year. EPS during the quarter was $2.25, a 15% increase from the same period a year ago. Operating income grew 6% to $4 billion, with operating margins expanding by 180 basis points. In terms of free cash flow, the company generated $5.1 billion through the first 3 quarters of the year, which was 36% higher from the prior year. Free cash flow margins for the company were only 8%, however, which was a nice uptick, but here's where you can really see the difference between Coca-Cola and PepsiCo, as Coca-Cola has 20% plus free cash flow margins. In terms of the dividend, shares of PepsiCo yield a dividend of 3.1%, and the dividend has been growing for 51 consecutive years, also making PepsiCo a dividend king. Looking ahead, analysts are calling for EPS of growth of nearly 8% next year, with revenue growth coming in slightly below 5% at $96.5 billion. Using these figures, shares of PepsiCo trade at a current earnings multiple of 22.3 times and a forward earnings multiple of 20.6 times. These compare favorably to the company's historical average of 26.1 times, which could be a bit high, but I do not see any reason as to why shares could not trade at a multiple around 23 times moving forward. In terms of price targets, analysts have an average 12-month price target of roughly $189 per share, implying 12% upside from current levels. Now moving on to Dividend Aristocrat number 3, which is Exxon Mobile, stock ticker XOM. Moving away from the consumer staple sector and moving towards the energy sector now, where Exxon Mobile is one of the largest energy positions on the market today. The company currently has a market cap of $395 billion, and over the year, shares of Exxon Mobile are down 5%. That now makes 3 dividend stocks that we've looked at today, all of them down on the year. But if you have watched any of my videos, my prior videos over the years, then you know that I am a value investor. I am constantly searching for high quality companies that may be trading a little bit lower right now and are not in favor, but they could be favor as the market turns. And that's exactly what the case is, what I believe the case is when it comes to Coca-Cola, PepsiCo, as well as Exxon Mobile. Exxon Mobile is connected a lot to commodity prices as well as volume in terms of crude and natural gas. You're going to see exactly what I'm talking about when we take a look at the results right now. In terms of the company's latest earnings report, Exxon Mobile reported revenues of $90.8 billion. However, that was a 19% decrease year over year. Earnings per share during the quarter came in at $2.27. That was a 49% decrease during the same period a year ago. Many of these declines are due to both falling commodity prices as well as a downturn in volume, which was expected. In terms of free cash flow, the company generated $28.1 billion through the first 3 quarters of the year, which although was 44% lower than the prior year. Free cash flow margins for the company came in at 10.8%. In terms of the dividend, shares of Exxon Mobil yield a dividend of nearly 4% after their latest 4.5% dividend hike, which this figure you're looking at doesn't yet incorporate. Exxon Mobil has increased their dividend for more than 40 consecutive years and counting. Looking ahead, analysts are calling for the company to generate EPS of $9.32 per share next year and revenues of $357.9 billion. Very little in terms of growth, but the valuation is still intriguing. Using those figures, shares of Exxon Mobil currently trade at a current earnings multiple of just 11 times and a forward earnings multiple of 10.9 times. These multiples are well below the company's 5-year average of 16.1 times. With many looking for oil prices to climb back up in the near term, this would be a tailwind for the company, making shares look even cheaper than they are today. In terms of price targets, analysts have an average 12-month price target of roughly $129 per share, implying more than 25% upside from current levels. So there we just looked at 3 high-quality dividend aristocrats. And remember, to be a dividend aristocrat, you have to be able to increase your dividend for 25 consecutive years. And as we saw, 2 of the companies on our list today have actually increased their dividend for 50 consecutive years or more. That shows a testament to the quality of the company as they're able to generate free cash flow year in and year out. And after all, free cash flow is what makes the dividend grow. Down in the comments section below, let me know, what are your thoughts of these 3 dividend aristocrats? Do you own any of these 3 dividend aristocrats? And if you haven't done so yet, make sure you smash that like button down below. Subscribe to the channel, and we'll see you in the next one. Take care.